Welcome to the Twomey Stock Market Report. I'm James Twomey, and today is January 5th, 2023, Thursday. And this is the market update. We're going to review some of the key items that occurred today and what's on table and what is next. We'll discuss that briefly. But I want to quickly go over a couple of things. So here at the Twomey Stock Market Report, what do we look at? What's going on fundamentally in the marketplace? Well, we're hearing it. It's strong and loud. The Fed notes came out yesterday, but we're talking potential recession. In reality, we're sort of halfway in a recession. As we talked in our previous segments about our four tenets of a recession or economic slowdown. And what also is really starting to permeate is the fact that long-term inflation is here. 2023, we do not expect to see the Fed to either pivot and start lowering rates. Yes, they may, after going up another, 0.75 to 1.25 rates throughout the rest of the year or the first half of the year, they'll pause. Not until they actually say we're going to pause rates increases is it really safe to go into the market. So we've got inflation. We know it's going to be here. Yeah, month over month, it's not going to change too much. It may decline year over year. Obviously, we're up in these 7% range. So we're getting used to it. The real key factor, what's next? Right now, everything's in a reactive trade mode. One day, market's up, next day it's down. So it's a very trader's delight because there's a lot of short-term volatility. Long-term trends are not existent. But we know overall, since January of last year, the market's been in a downtrend with the S&P down 20%, NASDAQ 34%, the Dow 10%, and it's continuing this year. So we're going to go over a couple of trades that we are actively and how we're handling that. So let's go right to it. We talked about the four tenets of recession. More to come. The big thing we're watching is unemployment. Tomorrow, we're going to get the data release of employment. Earlier today, we heard that the job creation was higher than expected. That put pressure on the market because it said, the Fed's going to continue to have to raise rates. So the Fed is working on the demand side. You've heard me say this before. What are they doing? They're working on the demand side by raising rates, curtailing economic activity and development and borrowing. They've affected the car borrowing market, the housing borrowing market. Really what hasn't happened, and we're starting to see it, these high-tech layoffs, Amazon, another 18,000, Salesforce, another 10,000. We're seeing more of a high-tech, it's going to be a high-tech recession, if you will. It's going to be more of that going on. They're not benefiting from the infrastructure bill. That's starting to hit. It's been taking a long time. So it's going to be a union, middle-class, blue-collar type. They're going to weather this much better. The only problem is once that infrastructure and CHIPS bill money and green bill money goes away, it ends, and then we're back in the doldrums. So that's a problem. So let's look at PSQ. We're short the NASDAQ PSQ, and this is the daily chart. And today we had a nice run up. We're starting to see a couple. If we look at our numbers, we look right down here at the bottom. The stochastic. Excuse me. The green is up above the red. It's at 91%, very healthy. We'd like to see that. We go up to the MACD, which is a longer-term oscillator, and you see how long it takes from early December to really the end of December to get into positive territory. It's staying there. The green line is above the red. This is an oscillator of time and energy, and it shows at the MACD's at a healthy 12.2. So that's a pretty good number. 0.2. I can't read my own writing. 0.24. So that's a healthy 0.24. So it's in the positive territory. So we've got that working. And then we go up here and I'm going to expand this, our daily chart. We break down our daily chart. We look at a couple of indicators. Of course, the 200 EMA, we're way above that. That's a major technical line of support. The 50 EMA is the next line of support, and the price is way above that, and the 50 has crossed above the 200, so it's been very positive since May, right? So even though we've had ups and down, overall that trend has been upward. So what do we look next? We look for our shorter term indicators. We go the 20 EMA, the 15 EMA, or 14, whichever you like to do, and 9. We kind of used, you could see how where we went long here when all these cross positive for us. And it's been basically hugging the 9 EMA all along. We had a little bit of a pullback here. And, typically we would have sold the third, but it was holiday time, so we held off. With that said, we're well above that. The RSI, Relative Strength Index, is 61.9. We get into mid to high 60s, we're going to get into oversold territory. And that means overbought, pardon me, I always mix that up. Overbought territory. What does that mean? It means that all the buyers are thinning out, and then, people looking at this, the trade might be exhausted, right? So, we were up around 66 and a half back on December 28th, and sure enough, it backed way down. We went as low as 59, and then we went low of 57, and here we are today at back up to 61.99 or 62. So we're hovering around that overbought. Fibonacci retracement from the low, recent low, and the recent high. We bounced from the recent high to the recent low, up 0.618. We talked about this before. If we could get past the 0.5, we did. If we can get past the 0.618, we got a nice run, potentially 1-to-1. I'm not in the prediction business. I use it just as a guidance, and we're now coming up with a 0.76. So if we can break the 7.6, it looks like we could potentially reach the last highs in the PSQs. It's going to be a slow decline in the market. Let's go to the long side, QQQ, just to give you an idea. Now we're looking at this from a technical. We assume fundamentally things haven't really changed. The pressure is on the economy. The Fed is trying to slow the economy. We've got the government spending tons of dollars, millions and trillions of dollars, keep the economy pumped up. That's gonna help keep people working, and therefore they can pay higher rates. The problem with pumping money with an economy that's low unemployment and pumping it with stimulus, it causes inflation. I mean, it's, economics 101, if you will, and, the government seems to be okay with that. So if that's the case, why fight it, right? The only problem is, where do we put our money? So we've been short. We're going to continue to stay short. If we look at the Qs, this is what I'm talking about. This is the long version on the daily chart. The last 1, 2, 3, 4, 5, 6 days, it really hasn't fluctuated that much, and it stayed, from the, if we look at, I'm doing a very short Fibonacci here from this recent high to recent low. It really, we're not getting any bounce from that. If we move this all the way up to the most recent high, and that was from that bear market rally that a lot of people got caught in, and we bring it down to the most recent low, we only came up to like a 0.5, and it's been on the retreat ever since, right? So that's a weaker retracement from that high. So now if we go at the daily chart, where do we expect it to go? That's the interesting dilemma, because two things. The RSI here is 37.4. It's getting near what we call now, this is the long side, oversold. If it gets into 35, not 30, 35, our antenna goes up. We look down here, the stochastics, very, very small, 7.95 for the green, and it's below the red. The MACD in negative territory, and that is -5, right? So the longer term oscillator is saying we're in negative territory. Look how long it took in negative territory over here. It went from early September, and it took all the way to November mid before it went positive again. So we could be down here for quite some time, but the RSI is telling us that there are people want to buy, and that's we have to keep that in mind. But for now, what is this telling us from the NASDAQ side? Remain short. We're going to tighten some stops, but you know, and that's it. There's no reason to be going long just yet in the market. One of the things that we looked at, we're short all the indices, but that is we also play the bonds, short bonds, and TBT has been struggling. We saw today a little bit of abatement. RSI is back down to 47, which is good. It was up in the high 61 to 61.77. In the last 5 days, it's really come down. Two things. If you look at TLT, which is this is the 20-year short 20-year Treasury. If you look at TLT, the long 20-year Treasury, yields come down if the government offers, or anybody, the less interest they offer on a bond. If you buy a bond for $100 and they go, it's 1% versus 2%, 1% would be a lower yield, right? You're getting less return on that $100. So if that's the case, TLT mimics that, and TLT happens to be the 20-year bond. That would go, that would go up, right? If yields are coming down. Yields come down when money is available, or the government's trying to get rid of money as much as they can. But for the most part, if yields are low, people are going to invest in other things like stocks and, long-term investments elsewhere because they're getting so little money on yields. If the yields start going up, TLT drops like it has here, and government or companies have to offer higher interest rates. At Carnival, they were offering 8-9% for some of their bonds because basically junk bonds. Nobody wanted to buy them. They needed. Hedge fund managers went out, were selling them and buying them because they wanted to show high returns for their investors. There's nothing wrong with that. But it's risky, right? The more yield you pay in a tough market, that means they're likely to there's a higher likelihood that they may perform poorly. So what's happening here is the TLT is trying to battle back. It is trying to make a move. The RSI, it's 51, so we really aren't oversold. We aren't overbought. It's telling us that maybe if there is a recession on the works, bond yields will not be necessarily high. If inflation continues, bond yields will be high. So we haven't got any definition there. Let's look at the SPY just to give you some idea in the SPY. That's what we use our proxy for the S&P. Same thing as the NASDAQ. It's gone sideways for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, almost a week and a half sideways. And the RSI is 42.78. Really, what are we seeing? Yes, it dropped. We had that precipitous drop from the most recent highs. It's fighting, but it's not moving very much. It's very sideways. So of course, the holiday trading, we don't expect much activity up or down. Sometimes you get the Santa Claus rally. We didn't get it. So what I'm telling people and my subscribers now, we're going to stay short. The bond fund, we're short bonds. I'm not 100% sure that's going to last, and we'll exit quickly if we do. We're in a reactive trade mode, which is very uncomfortable because it's very hard we want to be in a trend to make money, right? And if it's going sideways, it's good, but you have to predict the next trend. And that's where we're at. Fundamentally, the market says economic pressures, layoffs are coming, companies are going to perform badly, and we're going to be in some trouble other than the stimulus money coming from the government. So, let's look at the short end of the SPY. Same story there, sideways, but the RSI, it's up there, 56.85, a little bit of abatement from where it was in the 58s, but we're getting some volume here on the short side, but it's above our 9, it's above our 15 and 20 EMAs is above our 50, but it's hugging it. So it hasn't. We're going to either make or break this. It does. Really, we've got to get some activity from the most recent high to the recent low. We've basically had a 0.382 bounce on the short side, zero point 0.5. It got up to 0.5 and it's been repelled at the 0.5. So we need some conviction here. We haven't seen it yet. The MACD is strong. The stochastic strong. It's keeping us in the trade, but anything can happen. This is the reactive trade side because one day money comes in from nowhere and all of a sudden everybody gets the hands get flushed. So tough market to be in. We also went long Verizon. Verizon, we've been in and out last year. It had a 20% drop at one point in time. It's got a 6.3 dividend. There was a buy signal. I held off to get confirmation after the holidays. It's racing up. We're in this. We got in there in the low 41 or so. Let's see, where did we get in? 40.95. So we're going to potentially, this will race up to the 200 EMA. It's got a 6.3 dividend for the first quarter. Divide that by 4. So if we can, we're not going to fool around with this one either. We've got a tight stop on this. We were in XOM. That got stopped out. That's fighting back as well. Energy had a better performance today, but energy does not look good. If we look at USO, the reason why we got into energy before the holidays because we're reaching that $60, $65 barrel where the U.S. said they were going to buy. We also saw the back door of oil being shipped from Russia was opened up for Poland and Germany. There's all kinds of things going behind the scenes. But, the recession is saying less demand, less demand, less demand. And boom, we've got a drop here. So we need it to hold here. It doesn't look promising, to be blunt with you. If it doesn't rebound in the next couple of days, it's a very volatile trade. But we did get stopped out of our energy plays. And right now, we're also looking at some REITs because they're good dividends. This is not the one we're long, but I'm going to, let's see if I can find it actually. This is not giving us a buy signal yet. I went in on a mouse hunt. What's that? We go to a 120-minute chart. And when the 120-minute gives us a buy signal, we jump in, we ride it up. If it gets back, it did come back down, then we get stopped out. So we're close to getting stopped out here. We're not going to fool around with that. But we do have another one, NJY. No, what is it? It is NLY. The other one we have is, NLY. I always forget that. That one has got quite a bit of dividend. That is a dividend of 16.5%. So we're real interested in keeping that 16.5%. That's at pretty much break even right now, a little bit below. So that's another one that we'll be adding to shortly. I'm just watching it. We got plenty of time. The whole idea is if you look at this on a weekly basis, you're really, this is the kind of, you want to get in the sweet spot where this traded for almost a year and a half, 22.5 to a high of, 38. So, I mean, if you can get in there and you're at 21, it goes up, it goes down 10%. You're still going to make 16% on your money for the year, right? So you want this, so you end up with net 6 positive %. So we've got a nice little bounce there. We're going to be probably adding to that soon. And the other one is PAA Pipeline. That's the same kind of deal. It's got like 11% dividend. It's going sideways. That one is in sell mode, so we're going to wait on that. I still hold some, but I had everybody get out before the holidays because we didn't know where things were going. That's been bouncing around the 200 EMA. We just got the we're looking to get the buy signal on the 120-minute. We have not gotten there yet. We're just about there, so we're holding off on that. So what we're seeing is pressure on the market. It is not going anywhere in the short term. yeah, we're going to have these bear market rallies. Here's the diamond, right? It was proxy for the Dow for 2022. Came down. It's been in that downtrend. We had a bear market bounce here, then a lower low. We had a bear market bounce higher, and we haven't come back. We've been hovering around this 200 EMA for the Dow. And this is important. This is what's telling us technically that there's certain sectors of the market that are hanging tight, and that's more the industrial sector, the infrastructure play, eventually the chips play. We need to see that hold and not break. So right now we're going to stay short. I'm not advising to go long just because it doesn't pay long term. We need to really have a buy signal. We're not in a buy signal to go on the long side in anything right now. Let's take a JP Morgan, which had been a great ride. And, this is the daily. It had a great ride. It came down. It gave a sell signal. It is now just getting back into another buy signal. So that's what we're talking about. We need to see that buy signal and confirm. There we go. We have a buy signal. But if we look at it, stochastics are working down. The MACD is positive, 0.97 in positive territory, but we've got a lot of headwind on the marketplace. It didn't break the last high. It looks like this might be continue to go sideways, and that's what I'm talking about, reactive market. You sell here, it drops down a little bit, you buy right here or a tad underneath the sell signal, and we're up, and now we're back to the buy signal. Reactive trading. You're going to get, if we use our guardrails, the 9 or 8, 15 or 20 EMA, we're going to get in, and then we're going to get stopped out for a small loss. It is not good money management. We want to get in a trend and run it for a while. We got plenty of time. The market's not going to run away. If it does, we always can get in. And we know with interest rates going up in February, we've got another round of Fed interest rates coming after that. Chances are the market's going to be more of either we'd love it if it goes sideways, but chances are you're going to see another pullback, a bear market rally, and another pullback. And maybe we can go once we get. I'd like to see. I'm not in the prediction business. I'd like to see a nice strong pullback, a bounce from lows, or get to the near lows that we had back in the COVID lows. And then that's a good time for us to get into the market and ride a bear market rally. In the meantime, there's no sense if you put your money in Tesla or Amazon, you're going to get smoked. Look at Microsoft. We were in there. We got some nice gains there. Now it's way off. So there's no place to hide. The growth stocks are getting killed. Look at this, Microsoft. It's obliterated. So when we got our sell signal, we got out, and that was at 247, 248. Look at where it is now, 223, and it looks like it's trying to get down to the lows back here. And if that's the case, then if you're holding, you're going to get 100% loss. Not 100%, but you're going to get 1-to-1 loss on your investment. So we don't need to mess with that. So that's the latest from the Twomey Stock Market Report. Go to the number 2 mestocks.com. There you're going to get our updated weekly videos. We're going to get also our video alerts. You can sign up for our trade alerts. You can sign up for our technical alerts. You can get into our market letter. You can get into our educational videos that we have. Complete access, very easy to maneuver and manage through the website. So check it out, the number 2 mestocks.com. I'm James Twomey, and today is Thursday, January 5th. And if you're trading, it's a very reactive trading mode. You got to be nimble. You got to be quick. There's no easy way to make money as an active daily trader. There really isn't. So we're trying to wait for that next trend. Nothing wrong with that. You can always park your money. I've got 80% cash. I got some of that cash. I've also moved into short-term bonds, 6 to 12 months. Not getting a heck of a lot, but it's safety, right? And if worse comes to worse, I can always liquidate them, but I don't want to. But they're utility bonds, treasury bonds, tax free. You know, I'm not excited about earning a few percent, but I'm also getting something. I don't want to go in and buy. I hear all these people buy at the lows of Amazon. We're not there yet, so we'll have plenty of time. We're not going to miss it. I'm James Twomey. Email me at info@TwomeyStocks.com. That's the number 2, MEstocks.com. I'll answer any of your questions anytime. James Twomey.